live webinar, Beyond the Buildout, Unlocking Capital with the Dolfin TI Lease. I am Stoney Browder, Managing Director and Head of Marketing. And I'm going to turn the floor over now to Scott Manis and Keely Ryder, founders of Dolfin, to introduce themselves and a little bit of background about the company and the value that we bring to the market.
Yeah, thank you so much, Stoney. Like Stoney said, I'm Keely Ryder. I'm the co-founder of Dolfin. Thank you, everybody, so much for joining us today. A brief background on myself. I've worked in structured finance for the last roughly 10 years with a focus on credit-backed leasing. I've worked very closely with all the major brokerage firms and investment advisors previous to creating Dolfin. Scott and I created this company about 2.5 years ago with the big idea of redefining and reimagining how tenants and landlords capitalize their transactions. With that, I'll pass it off to Scott for his introduction.
Thank you, Keely. Hi, everyone. Welcome to the first of a series of webinars hosted by Dolfin. I'm Scott Manis, co-founder of Dolfin. I've spent the past 30 years in structured real estate finance with a focus on corporate real estate finance, including sale-leasebacks, credit tenant lease financings, and tenant improvement equipment financing. When Keely and I founded Dolfin 2.5 years ago, it was important for us to develop a tenant improvement financing product that was a simple and a cost-efficient solution to funding tenant improvements, equipment, and other occupancy-related costs. I believe we've accomplished those objectives with the Dolfin lease, which Keely will describe to you in more detail.
Thanks so much, Scott. So the introduction to Dolfin, a little bit about Dolfin. We're bringing a new perspective to tenant improvement financing. We view TI expenditures, or commonly referred to as CapEx, we view them as a source of recoverable capital, right? That can be reinvested for higher value business opportunities. Based on decades of leaseback financing experience, we've successfully brought new liquidity, transparency, and simplicity to the TI financing product with the introduction of our 5-page Dolfin TI lease, which is now widely adopted throughout the commercial real estate industry, thankfully. With $300 million of assets under management, we're gearing up to write many more TI leases during the rest of 2025 and beyond. Now, why is this such a challenging industry, right? Everybody's back to office, occupancy is returning to pre-COVID levels, everything seems great, right? Well, it's our view that the industry remains challenging because capital markets have been really slow to reinvest and commit, so to speak, to real estate, despite its impressive recovery. And so as a result, we're seeing a lot of the costs being consistently shifted towards tenants. And both rising occupancy costs and reduced TI allowances from landlords are forcing tenants to invest more of their own capital into improvements. So today, we'll discuss the problem with traditional tenant improvement financing, the Dolfin TI lease solution, how it works, who it's for, and some real-world success stories. So if I'm a tenant and I'm fitting out a space, right, I usually get some sort of tenant improvement allowance from my landlord, depending on the market, the landlord profile, etc. But I'm likely also spending above and beyond that allowance out of my own pocket in order to complete the build out. So I have one of two options. I put up the cash on day one, or I tap my credit line or take out a new bank loan, right? Spending cash day one, I think we can all agree, is an inefficient use of capital. It diverts capital from your core business operations, and it ultimately yields zero return because TI has no residual value. You can't take the doors and the walls and rip them out when you vacate the premises. And now you've essentially purchased an asset in space that you lease. An asset, not to mention, that will eventually revert to your landlord when you vacate the premises. So I've decided never to do that as a tenant, right? And instead, I'm going to go fund it on my credit line. Well, that has drawbacks as well. Bank loans are typically short-term, anywhere from 3 to 5 years, and in some instances, they're secured by company assets. So this option also pulls a lot of cash flow in the early years of your build out. And we also view that as an inefficient use of funds. But here's the thing, right? This is how tenant improvements have always been financed historically. There have been no alternatives, no other ways until now. So we're introducing the Dolfin TI lease. What is the Dolfin TI lease? When Scott and I formed Dolphin, we wanted to create a product that streamlined and improved tenant improvement financing by offering the first alternative to bank debt. So we created a simple 5-page lease that is coterminous with your space lease and fully unsecured. So if your space lease is 10, 15, even sometimes 20 years, the Dolphin TI lease will match that duration. We're also favorably priced based on the tenant's credit, and we're quoting rates today from anywhere to 6.5% to 10%. Our lease can be used for new buildouts, renovations, subleases, or even to get cash back from improvements you've already paid for, which Scott will highlight shortly. We can fund TI, furniture, fixtures, equipment, related soft costs like architectural fees, and leasing commissions, all within our lease. And part of the streamlining strategy that Scott and I came up with was to make sure we can close these deals quickly and efficiently within 60 days, right? Because we're all familiar with the fatigue that can come with closing on typical financing. So we wanted to make sure we really streamlined that closing process and made things as smooth and efficient as possible. So who can use our Dolphin TI lease? We're used by both tenants and landlords. We replace landlord capital as well. And we typically work with public and private companies that are middle market and above. When we think about credit-worthy tenants, we require a revenue of around 100 million and a minimum EBITDA of around 20 million as thresholds that we can go by. For public companies, we simply apply their public rating in order to price. And for private companies, we require 2 years of financials in order to shadow rate and apply a corresponding TI interest rate. And luckily, that shadow rating process is also very streamlined and takes only about 2 weeks. Important to note that we can finance any project from 2 million and above, and this product isn't just for corporate offices. We've had experience with healthcare clinics and systems, universities, data centers, industrial facilities, law firms, professional services, and we've been known on occasion to finance a solar project or two. And with that, I'm going to toss it over to Scott to dive into some of our recent case studies. And those of you who are in attendance, please feel free to drop any questions you may have in the chat. Thanks so much.
Thank you, Keely. Today, I would like to discuss 3 case studies of recently closed Dolphin transactions utilizing the Dolphin lease to finance the construction and fit out of newly leased space and to reimburse tenants for monies previously expended for currently occupied space, which are the 2 primary use cases for the Dolphin lease. The first case study is for a transaction that Dolphin financed for Art Health, which is a developer of state-of-the-art cancer radiology centers. Art Health approached Dolphin to finance the tenant improvements and equipment for space that it leased in Newport, California, which was the location of its first radiology clinic. The ask was simple: finance as much of the cost of the $30 million fit-out as possible over as long a term as possible, recognizing that the fit-out was special use and required $15 million of equipment financing as well. Dolphin responded by providing 100% of the financing for the fit-out and equipment purchase using the Dolphin lease. Dolphin structured a 6-month construction period, which included the acquisition of the equipment, and amortized the total cost into a monthly rent payable over 10 years. Because Dolphin was able to finance 100% of the cost of the fit-out and equipment, the tenant did not have to raise equity for the project and was able to retain more of the project's economic benefit. The second case study is a transaction Dolphin financed for North American Casualty and highlights the second primary use case for the Dolphin lease. Dolphin was approached by North American Casualty to seek reimbursement of $23 million in tenant improvements that it had recently expended in its Rockefeller Center corporate headquarters space. Dolphin responded by reimbursing 100% of the cost of the fit-out through the Dolphin lease. The lease was structured with a monthly rent payable over 12 years. The financing allowed North American Casualty to reinvest the proceeds of the financing into long-term, high-earning assets, thereby increasing the tenant's ROI. The third and final case study that I'd like to share with you today is with Applied Underwriters. applied underwriters approached Dolfin to finance $150 million of tenant improvements to complete the construction of its corporate headquarters in Omaha, Nebraska. Dolfin responded by providing $150 million of 12-month construction financing to complete the fit-out of the space, which converts into a monthly rent at completion payable over 15 years. The financing allowed applied underwriters to match fund the cost of its completion over 15 years rather than drawing on its short-term bank line of credit to complete the project. Stoney, back to you for questions and answers.
Yeah, I'd like to add that, we're really proud to say that our clients return to work with us on follow-up projects. And even though you've just heard about 3, a lot of our clients continue to use us, for project 2 and beyond.
So that brings us to the question and answers section of our webinar. And what I will do is I will open up any questions that we've already gotten. I'll ask you guys those questions. You can answer them. Also, if you want to ask a question now and you don't want your name to appear, there's a little tick box underneath there that you could just click and you will just show up as an anonymous user. So let's take a look at the questions that we have. Okay. First question. Does Dolfin help cover build-out costs outside of TI?
Yes, Dolfin will finance all costs related to occupancy. Those include soft costs, hard fit-out costs, equipment, leasing commissions, and free rent.
Okay. And the next question is, if a tenant has already started or completed their space build-out, can Dolfin still offer financing support?
Yes, I mean, Dolfin can reimburse the tenant for TI that it's already expended in the space and finance the completion of construction that's in process.
Okay. And next question, from initial outreach to funding, how long does it take to complete the financing process?
It typically takes from 30 to 60 days for a tenant that is publicly rated, and it takes a little bit longer, another 30 days for private credit. About half the tenants we see are private companies, and we require 2 years of financial statements in order to review the company's creditworthiness, and that typically takes a little bit longer to review.
Okay. What makes Dolfin's financing model different from a traditional bank loan or landlord-funded TI?
So to traditional banks, and I think the primary advantage to the Dolfin product is that it's long-term. Typically, we see lease terms of 10 years and up. Most of the transactions we finance to date are between 10 and 15 years. We'll finance transactions as long as 20 years, and sometimes 25 years, depending on the credit. And so it's a way for a tenant, our product's a way for the tenant to match fund their occupancy cost to their funding. And our product does that. And as far as we know, it's the only long-term financing product out in the market available to tenants.
Yeah, and I would just jump in and say, versus the landlord, our product is structured a lot like a landlord tenant improvement allowance. However, landlords have a cap on the amount of money that they can give tenants today, which is getting less and less and less, and tenants are requiring more and more capital. And so not only do landlords cap out, but there is an implicit rate charge within your tenant improvement allowances by the landlord. And in most cases, our rates are actually lower than what your landlord is charging you.
Great. How are the repayment plans structured?
So typically, the repayment plan for the TI lease runs coterminous to the space lease. So if your space lease is 10 years, our TI lease is 10 years. If it's longer, our lease is longer. For reimbursement of TI, our lease is matched to the remaining term on the space lease.
Thank you, Scott. And we have another question. How long of a lease can you finance?
We can finance up to 20, 25 years on the right credit. We often see 20-year leases, particularly for healthcare credits. So we can go as long as 20 or 25 years.
Thank you. And are your financing options limited to certain sectors, or do you work across industries?
We're agnostic as to both property type and industry. Our focus is really credit. Um, and first and foremost, because our product's unsecured, we want to focus on creditworthy tenants. Creditworthy to us is a big spectrum, but it's typically $100 million of revenue and 10 to 20 million of EBITDA and up.
And I have one more question. Are rates variable or fixed?
Our rent structure is fixed, and the rent is simply a derivative of amortizing the costs of the fit out plus the rate over the term of the lease.
Right. So, another question we have, what approval do you need from a senior lender?
So senior lenders, it's kind of, I would say, it's the biggest constraint in the market, whether it's our financing or whether it's some type of alternative financing. We've structured our products so that if we're in the process prior to the lease being signed, we typically are able to avoid the senior lender because our lease serves as the only collateral for our loan. And so, to the extent that that lease is between us and the tenant, it doesn't require senior lender approval.
Yeah, and when we are signing directly with tenants, say our client is a tenant, it requires zero senior lender approval. It's just a transaction between us and the tenant. Scott's referring to if we have a landlord transaction, we also sign directly with the tenant and thereby circumvent senior lender approval.
And yeah, that is it for the questions and answers that I have here. And yeah, so I think if there's no other questions, that's going to conclude our very first Dolphin TI Lease webinar. I'd like to take this opportunity one more time to thank you all for joining us today. If you're looking to learn more about Dolphin, you can visit us at dolphinpartners.com. If you want to get in touch with Scott Manis, his email is scott@dolphinpartners.com. Keely Ryder is keely@dolphinpartners.com. And we look forward to hearing from you.
Thanks so much, everyone. Have a great day.
Thank you, everyone.